So Chris and I saw each other the other day, and we just started geeking out, talking about what's going on in the real estate market.
We're great at geeking out.
Yeah, we are. We really are. On this, data and analyzing what's going on in the real estate industry, as well as the mortgage markets, which obviously they're all go hand in hand very much.
Yes.
One of the things that gets talked about sometimes, but maybe not enough, is the regulation part of the mortgage industry.
Yes.
I think everybody can agree. I don't think many people can argue with it. The problems that we had in 2007, and of course, when it really fell in 2008, a really big portion of that had to do with poor lending standards.
Yeah.
Is that fair?
Well, literally, what had happened leading up to that was the deregulation of lending per se.
Yeah.
And there were a lot of schools of thought behind that, really to make the lending process more readily available to more people.
Yeah.
Right. And that's something that we're going to have to watch moving forward now with the way that the market's going.
Absolutely.
We have to be careful not to have administration step in and say, well, we need to make this easier for everybody and end up back in the same place.
Yeah.
So in that effort to make loans easier and more available to more folks, it just meant that the stability of those loans were nowhere near compared to the stability of loans today based on today's regulations. And so, yes, ultimately in the end, it was a perfect recipe for millions of people to be in a mortgage that anything goes wrong, a layoff, a fluctuation in income, and then things begin to destabilize. And so, of course, there were other things at play, but those readily available, easy to obtain mortgages certainly didn't help at all.
And the thing is, they don't exist today
No.
to the way they did back then, right? Adjustable rate mortgages, they're really not a thing, right? I mean,
this fixed rates are so good that the benefit of an adjustable rate, we don't see it in our market. It was, those were good short-term scenarios where that maybe the adjustable rate would be a full percentage lower than a fixed, but only for a period of time, maybe for 5 years. And then at the end of the 5 years, you had to make a choice, either to refinance into a fixed, or maybe you were only going to keep the property for 5 years.
Yeah.
And so, but right now, fixed rates are so competitive, they're so low that we simply are not doing fixed, or we're not doing variable rates at all. We're not doing any variable rate mortgages in our business.
So if we go back to 2000 and, well, actually, I've got the chart here. If we go back to 2000 and let's say 2005, 2006, mortgage rates were around 6%, right?
Yes.
And they actually moved up in 2006, 7, I guess it was, almost to 7%, right? And the thing that's interesting about that, 2007 is really when everything kind of came to a head and was like, okay, we got a problem here, right?
Yes.
The thing that was interesting, though, home prices really didn't start declining until a year later.
Right.
So I guess what I'm getting at is there was a reason to have adjustable rate mortgages back then when you had a 6-7% mortgage rate, right?
Yes.
Now we're at these 3.25%, 3.5%, right?
Right. So the need for the variable and the ability of investors to hold and service them at a low enough interest rate to make it lucrative for the investor, right? The market just doesn't need the variable rates the way that they did. But rates at 6%, 7%, if you could get a variable at 5%, for at least 5 years, and you're going to sell the property or you're going to refinance, then there used to be benefit to it. So.
And I think the crux of this conversation is the mortgages that have been made in the last, let's say, 10, whatever it is, back to 2008, 9, right?
Right.
These are very well underwritten mortgages.
Yes.
They're good.
Yes.
People want to buy them. They're not junk. They're not junk investments, right?
Right.
Right. And so, when we talk about differences now versus then, that's a big one. Now, obviously, now versus then, we've got this huge move in home prices, home price appreciation, which is concerning for a lot of reasons. One of which is just affordability for people that want to get into buying a home and owning a home.
Yeah.
And so there's some challenges there.